best known for its NGL logistics and handling assets. Also has obviously a very big gathering and processing business and does a lot of the diluent logistics for the oil sands. What might not be as well known is the company's enterprise value now exceeds $10 billion. So it's grown a lot since I started covering the company. Very pleased to have David Smith with us here, President and CEO. Welcome, David.
Thanks, Rob. And you have been covering the company as an equity analyst for a long time. So
that's right.
Appreciate the invitation here. Appreciate CIBC putting on this conference, and appreciate CIBC doing it in Alberta.
You're welcome. Just again, a reminder that we do appreciate the questions. If you have anything you'd like to ask, just raise your hand, or you can set it up to us here on the conference app. So starting with just a rear view look at 2019, what do you think the biggest accomplishment was for the company in 2019?
Well, I think we've had a very successful year financially, but there's two big accomplishments in 2019 that stick out for me. One is the announcement in the early part of the year that we're going forward with our KAPS liquids pipeline project. KAPS is a liquids pipeline from the Grande Prairie area, which is one of the most active areas in the Western Canada Sedimentary Basin in terms of drilling activity and production growth. And the producers in that area need more egress for their liquids, for their condensate and their NGL mix. So that pipeline will bring the condensate and NGL mix directly from the Grande Prairie area into the Fort Saskatchewan fractionation and storage complex that we have there. We're doing that project in partnership with SemCAMS Midstream, and KKR is a private equity funder behind SemCAMS Midstream. So we're very excited to work with them as a partner. They bring lots of strategic benefits to the project, and as of today, that project has been proceeding extremely well in terms of the regulatory process, the Aboriginal consultation process. We're on schedule. We'll be filing the last elements of the regulatory application within the next couple of days, and we're optimistic that we'll be putting shovels in the ground later this year and have a commissioned pipeline by the early part of 2022. So that's number one. And then second most significant thing for us in 2019 was the commissioning of the Wapiti gas plant. Mm-hmm. Wapiti is by far the largest, most significant greenfield development that we've ever done. It comes complete with 150 million cubic feet per day of sour gas processing capacity, water handling, condensate handling, liquids extraction, acid gas injection, and it's really and gathering and compression too, to serve the producers in that area. Our primary producers for now are Paramount and Pipestone. They have been gradually ramping up their volumes through the latter half of 2019. And we are underway with phase 2 of that plant. So by mid-year this year, we'll have a plant that can do 300 million cubic feet per day once phase 2 has been commissioned. So I think, you know, that we've had lots going on. We continue to invest for growth, but those are the two accomplishments in 2019 that stand out for me.
Yeah, one thing that I think really helps the investors is the launch of the inaugural Investor Day. And I bring that up because you had some interesting comments about your outlook for the basin, which I'd love to hear you talk about that again. I mean, what we've seen so far is changes to the NGTL tariff, improving AECO, NYMEX differentials. So do you think we've seen the worst of this down cycle for the producers on the gas side?
Yeah, I believe in December at our Investor Day, I said I was calling the bottom for the industry in Western Canada. We've lived through more than 5 years of unprecedented headwinds for the industry in terms of commodity prices and issues around egress and regulatory constraints and delays. But I think there's a number of things that are pointing in a very positive direction for me right now from an industry perspective. The prospect of LNG going forward on the West Coast with the Coastal GasLink that TC Energy is building to bring Western Canada Sedimentary Basin gas to Shell's project at Kitimat, and then from there to the Asian markets that are really desperate for more natural gas. I think Canada can be a wonderful player worldwide in providing hydrocarbons generally, but natural gas specifically. I see it as being one of the solutions to addressing climate change, at least in the near term. Secondly, the Trans Mountain expansion project finally going ahead. and I am optimistic that it will get built in a reasonable time frame at this point, along with the Enbridge Line 3 replacement. And there's even some indication that we might finally see Keystone XL moving forward. So that's on the natural gas side. On the liquid side, I see lots of reasons for optimism. You mentioned some of the debottlenecking that TC has done within their Alberta system and the change in contracting methodology that allows natural gas to access storage. We expect that will mean much more stability and much more positive prices during the summer for natural gas. And then I think there's also some positive developments in terms of natural gas liquids like propane, in terms of creating additional demand for the propane that we produce. So for all those reasons, I'm optimistic about the outlook. I don't see that we're going to have a big dramatic rebound, but I think we're on the road to a gradual recovery.
Normally at this point in the credit cycle, I'd ask you a little bit about how you're managing counterparty credit and things like that. But I think it's probably a better use of time today to talk about how your vision of optimizing your portfolio of gas plants in the West Central Alberta area. So describe the benefits you see for stakeholders there.
So the West Central Alberta portfolio it's been a wonderful portfolio for us. It's been quite stable. We have 13 or 14 gas plants that are mostly interconnected with existing gathering network. But the reality of the last 5 years has been that the drilling activity has not been sufficient to sustain any growth in throughput. And so we have a network of facilities that is on average less than 50% utilized. That creates unnecessary costs and inefficiencies, and we've determined that it makes sense for us to address that and to try and make our network as the industry-leading network from a cost and efficiency point of view. We have the benefit, because of our interconnections, of being able to do that without investing a lot of capital. And a perfect example of that is what we did in the fall with our Gilby gas plant, where we were able to, without spending any capital at all, we were able to accommodate more than 90% of the throughput from Gilby at our Rimbey gas plant, which actually has a lower cost and higher netback for the customers by virtue of the existing interconnections between those two plants. So we're looking to do more of that. We'd like to get our utilization up to something more than 60% in the area. It's good to have some spare capacity available for the prospect of growth that we see in the future. But at the same time, we need to make sure that our system is competitive, and that means putting the same volume of gas through fewer plants, which lowers the per unit cost and allows us to take costs out of the system and improve the netback for our customer, and ultimately improve our bottom line as well.
All right. I have a follow-up question that actually dovetails nicely with one of the questions from the audience here. So what does all that mean for your appetite for new investment in gathering and processing? And to put this in context with the question I got from the audience, with Canadian E&P valuations trading as low as they are, basically near all-time lows, would you look at acquiring producer infrastructure? And what kind of environment do you need to see to be able to do that and expand the footprint?
Well, on the second question first, I guess we always look at acquisitions of gathering and processing assets, but we have some fairly well-defined criteria about what makes sense to us, both in terms of economic criteria as well as in terms of the characteristics of the facilities that we would be interested in. Quite honestly, we've had a lot of facilities offered to us over the course of the last 2 or 3 years that we're just not interested in. They just don't fit the criteria of sustainability and growth and flexibility and integration that we see as being important to our long-term strategy. And so it is a part of our strategy. Our Simonette gas plant, which has grown now to become the largest gas plant in our portfolio, it was an acquisition from producers back when we bought it over 10 years ago now. So it is an important part of our strategy. The nice thing about acquiring a facility is you get immediate throughput and immediate cash flow, unlike a greenfield investment that takes longer to ramp up. But at the same time, we are still going to be disciplined in terms of acquiring the facilities that make sense for our portfolio that fit with our criteria. We've invested a lot of capital in the area around Grand Prairie, to answer your first question. We've expanded the Simonette gas plant. We've just commissioned the Wapiti gas plant, as I talked about earlier, and we have construction at the Pipestone gas plant well underway with our partner Encana, Ovintiv. And so those investments combined represent a couple of $1 billion of new capital in an area that needs the capacity because of the growth that we're seeing in those areas. Do we have an appetite for more investment? Yes, probably. But at the same time, we like the footprint that we've created in that area, and I think we're going to be a fair bit more cautious going forward, at least for the next 2 or 3 years, now that we've established that footprint. And again, going back to the south region, in the area where we have excess capacity, the advantage we have is that we can accommodate volume growth without having to invest any additional dollars. So that if we see a recovery in activity, that's growth that goes straight to the bottom line.
Yeah. Any questions before I move on to dig into the KAPS product? Okay, maybe we'll just spend a little bit more time on KAPS then. I think it's safe to say you've had aspirations for building a similar system for quite some time. So what happened in 2019 that we were able to have the breakthrough and sanction the project?
Well, I think you're quite right. It's a project that we've had in our minds. We've proposed it in a couple of different forms over the course of probably the last 5 or 6 years. I think what has come together for us in 2019 is really just a realization among the producer community of 2 key things. One is the growth in volume will be there. The development of the liquids-rich Montney in northwest Alberta is creating a growth in natural gas liquids that will need that transportation capacity. And I'm talking about both NGL mix as well as condensate. It's the condensate that's driving the value of the development in that area for the producers, but that condensate, in order to turn it into cash flow, needs to have egress. So there was a realization among the producers that we've been talking to for several years that capacity was needed. And the second thing that's just as important is that they need a competing alternative to the monopoly that Pembina has on liquids transportation egress in that area. And so the producers that signed up and gave us the commitments that we needed to move forward, they're taking a long-term view, and they're realizing that from a longer-term perspective, having 2 competing alternatives for liquids egress in that region is going to be better for the industry than just having one.
Yeah, it's interesting to hear you say that, because we did just speak with Pembina, and they had some pretty optimistic views of how big their system can grow in the fullness of time. And
there's no question that over time there'll be more than enough volume for both systems.
Yeah, I don't think the investment community really sees that yet, because we're all, quite frankly, we're looking down at the low gas prices and things like that. But realistically, if things play out the way that's expected, it should be a lot of volume.
Well, the other factor that I think gives us confidence is the LNG, the prospect of LNG that I talked about earlier. When you look at the companies that will be feeding natural gas to that LNG facility, they're all going to be focused on the most economically attractive gas resource development, and those are the areas that are rich in liquids. And that'll be in northwest Alberta and northeast BC. So that's another reason why we're very confident that growth in liquids volumes will continue to be there, because it's a natural outcome of the natural gas that will be feeding those LNG projects.
When you announce KAPS, it's a very important and big project in its own right, but I can't help but to jump ahead and think about what are the downstream opportunities that you might see with that. Maybe start on the fractionation side. Where do you see frac capacity, and is there a need to expand some of the fractionation?
Not as of right now today, but for sure over the course of the next 2 or 3 years, that's something that we'll be looking seriously at. I would also mention opportunities both upstream and downstream, right, Rob. There's no question that the KAPS pipeline and the liquids egress that it provides will strengthen the franchise that we have in the gathering and processing facilities that I talked about earlier. But we will also see growth opportunities in and around the Fort Saskatchewan hub. That's where those liquids will be coming in growing volumes. The industry will need more gathering or more fractionation capacity, more storage capacity, more marketing facilities, and I also expect that there'll be more derivative downstream kinds of investments to create more attractive markets for those liquids.
On this project, you've partnered with some group. What generally is your approach to partnering, and what specifically did they bring to the table in this project?
Well, it's interesting. If you look back over our history, we seem to have developed a reputation and a skill at having good, well-functioning joint venture partnership arrangements. In each case, I would say that it's the strength of the partnership is, first of all, being aligned in terms of the objectives of the partners, but secondly, each partner bringing something to the table other than just money. And I think in the case of the CAPS joint venture with SemCAMS Midstream has a number of facilities, some legacy facilities and one brand new facility in the Wapiti area that will ultimately be a source of additional liquids on the system. We compete with them in certain respects in that area, but at the same time, we are very much aligned in terms of the desire to bring liquids onto a system that represents a competitive alternative to the incumbent.
Right. As you mentioned, they're now owned by KKR. How does that change in ownership affect anything surrounding the JV?
Well, when we partnered with SemCAM Midstream, they had already done their arrangement with KKR, and frankly, that was one of the things that we were excited about because KKR is a well-established private equity player that's quite keen on being a part of the development of infrastructure in the Western Canada Sedimentary Basin. They have taken, perhaps you could call it a contrarian view, but over the course of the last 3 or 4 years, they have taken a very constructive stance on investment in Western Canada Sedimentary Basin because they see the growth opportunities the same way we do. So, I mean, we're excited about the strategic and facilities synergies that we see with SemCAM Midstream, but we also are excited about the partnership with KKR.
Right. You talk about partnerships. You were also partnered, obviously, with Kinder Morgan at the Baseline Terminal. Pembina made that acquisition and it invoked the ROFR, which you decided not to exercise. What led to that decision?
Price.
Price is everything, isn't it?
No, I think, let me just take a little bit of a step back. We love that asset. The Baseline tank terminal that we built in conjunction with Kinder Morgan was an opportunity that grew out of the existing relationship that we had with Kinder Morgan. They had access to crude streams and storage. We had the site that we were looking for opportunities to develop. And again, bringing those two capabilities together in a 50-50 joint venture, it was a perfect marriage. We have long-term contracts with very creditworthy counterparties on that site, tied to crude oil, which is going to continue to grow, and we have expansion capability on the site. So we very much like the investment. We see lots of opportunities for ancillary services. When Kinder Morgan sold out of Western Canada to Pembina, there was an opportunity to exercise a ROFR on that site. But once again, we've been very disciplined in terms of the rates of return that we expect on assets. And suffice it to say that although we like the asset, we don't like it at any price. And I would also add that we're actually quite excited about working constructively with Pembina. I think that the business development opportunities on that site are actually stronger with two of us working it together rather than either of us working it on our own.
Yeah. I'm probably an outlier here, but I don't see marketing as a dirty word. But explain to us how you see marketing fitting with the business and your risk management philosophy there.
Sure. I don't see marketing as a dirty word either. A lot of folks have suggested to us over the years that we should call it something else, like logistics services or something like that. Quite honestly, I think we pride ourselves on being transparent and open about the risks in our business and where we see the opportunities. We've had a great synergy over the years between our infrastructure business development team and our marketing team, because the marketing team sees the opportunities in the commodity business, the supply-demand fundamentals that we see for the commodities that we handle, like propane, butane, condensate, ethane, isooctane now. And so they help the infrastructure business development people to identify opportunities, but conversely, the infrastructure team is looking at ways in which we can enhance the returns on the investments that we make by providing opportunities for the commodities teams to do what they do. So our ideal investment is one where we have a foundation of fee for service based on contracting the capacity for term. But also where we keep a little bit of that capacity available for the kinds of things that our marketing team can do. We have access to the capacity, but we also have access to the information that gives us from operating those facilities. So philosophically, that's kind of the way we've approached it. Now, it's important for us to maintain a solid foundation of fee-for-service cash flows, and what we've said recently is that we want to maintain that at around 75%, or at least 75%. So whenever we make a new investment, we're looking at building in that foundation of fee-for-service business first, and then we'll look to add the marketing opportunities on top of that. And so philosophically, that's the way we approach it. But the marketing segment has been good for us. We've made good money. We don't turn down opportunities to make more money when they are presented to us. But we want to keep it to a reasonable portion of the portfolio.
Right. We're getting a lot of questions here on ESG generally, as we market as analysts and again at the conference. So the company's got a pretty good track record, I would say, certainly on health and safety issues. What's your approach to ESG in general, and what currently is the most important ESG initiative?
I don't know if I would point to one particular initiative as being the most important, but maybe I could take a step back, and we are actually quite proud of our track record on the E and the S and the G. We've been, I think it's our culture to be probably a little bit understated, not blow our own horn too much. We've provided more disclosure over the last couple of years with respect to ESG metrics and accomplishments, because that's something that the external audiences have been looking for, and we've got, I think, some credit from those audiences for what we've accomplished and some of the improved disclosure. In terms of things like gender diversity, we're not where we want to be, but we're working hard to try and make sure that we're making progress. In terms of governance, I think we've always been a company that has scored very high with respect to governance, and we do that not because we want to be at the top of the list that get published every year. We do it because it's the right thing to do to be a well-managed business. Of course, the thing that's gotten a lot more attention externally is the E part, the environmental part. And so we've been a lot more transparent about the accomplishments that we've had in reducing fugitive methane emissions and reducing greenhouse gas emissions. We have 5 facilities that are part of the TIER program that the Premier talked about earlier today, where we pay a carbon levy that goes into a fund that's going to generate technological development resources within the province. And as the carbon tax regime evolves, that's something that we've been paying close attention to. With the facilities that we have, a lot of them are large, complex facilities. We have, on an ongoing basis, looked for opportunities to conserve energy, to make them more efficient, and at the same time reduce the air emissions and reduce the environmental footprint more generally. So these are all things that we're working at. We've talked internally about developing more specific targets for these things, which we will continue to work on. But in the meantime, I'm quite proud of the track record that we have. And one of the things that I would say, and this is another theme that the Premier talked about earlier today, the Canadian industry is better than in terms of developing and producing oil and gas. We're better than most jurisdictions around the world. I firmly believe that, and I think when people start to give us credit for the facts in terms of what our performance is environmentally, socially, and governance-wise, I think that we should get credit for that, and we should be the last barrel or the last MCF produced in the world.
Yeah, it's interesting to hear you talk about the diversity. I sat in on the TransAlta presentation today. Don was talking about the difficulty with diversity is there tends not to be a lot of applicants for plant operations. So
that's definitely an issue.
Yeah.
The talent pool when it comes to operations and maintenance doesn't include a lot of females, and we're actually working with some of the trade schools, some of the community colleges, some of the technical schools, to try and do what we can do to address that.
Right.
But the reality is that our culture encourages or discourages females from going into those fields. In the salaried ranks at Keyera, we're pretty close to 50-50. Females, females to males. So when it comes to the professional people within our organization, we've made a lot of progress. Now, having said that, we're not anywhere near 50-50 when it comes to the more senior levels of leadership. And that's what we're working to try and address, is to create more opportunities for mentoring and sponsorship so that we can see more women leaders progressing and have them be more a part of the senior leadership team.
I'm going to backtrack a little bit here because we did get a question on the app. There have been some disclosures over the last couple of weeks in the Wapiti plant. So how would you describe the ramp up at that facility and, dealing with the different gas composition getting from Pipestone and Paramount, and what do you have to do to optimize the plant in 2020?
So we had the usual kind of startup glitches as we commissioned that plant in Q2 and Q3 of last year. Part of that was due to some mistakes we made. Part of it was due to some unanticipated issues with the composition of the gas that we started processing early on. But these are all issues that we've been working through, and it's a real focus of ours to improve the reliability of the operation through 2020, and also ultimately to reduce the per unit cost and make this the most attractive plant in that area for the producer's gas. We did have, we were making really good progress with respect to reliability. The plant was processing earlier this month around 100 million cubic feet per day. So the phase one of the plant was about 2/3 utilized. Unfortunately, we had an electrical failure about 2 weeks ago. One of the pieces of electrical equipment at the plant failed and took the entire facility down. We, as we always do, we worked very closely with our customers, Paramount and Pipestone, at the facility. Because of the significance of our plant to Pipestone's production, they and Paramount decided that they should press release the impact. We told them at the time that we expected that it would be roughly 2 weeks to get the plant up, and what I can tell you is that as of yesterday, it was operating again.
There you go.
So we're working to get to the bottom of what caused the issue, and to try and use that as an opportunity to once again improve the reliable operation of the facility.
Given your background as a former CFO, I feel like I can ask you this question, but we're dealing with some pretty low interest rates.
That was 12 years ago.
Yeah. What does this mean for, in terms of how you finance the company, set dividend policy, things of that nature?
I'm sorry, what?
The question is, how is the very low interest rate environment that we have here impacted financial strategy?
To be honest with you, we don't really think about the low interest rate environment from the point of view of financial policy or strategy. We do, so obviously we take it into account when we're looking at the appropriate mix of debt on the balance sheet. And I think with rates being where they are, we will certainly continue to take the approach of terming out the debt when we see attractive opportunities. But we've tended to be fairly conservative and fairly simplistic, and when it comes to financing strategy, where our corporate structure is pretty simple and our financing is all on the balance sheet. Last year, 2 years ago, with the benefit of a public debt rating, we did our inaugural long-term public debt offering, and then last year we did a hybrid offering, which was an opportunity for us to build some equity treatment into the debt facility. Somewhat higher coupon, but much better equity treatment from the point of view of the rating agencies. And what that did for us is it put us in a position where we have visibility to be able to fund the entire capital program that we have underway now without having to resort to any discrete common equity issuance. We still have a DRIP in place. We are looking to how quickly we can eliminate the DRIP, because we understand lots of investors are not keen on the dilution that creates. But in the meantime, we need to make sure that we prudently fund the capital program that we have in front of us, and we'll look at addressing the DRIP once we have confidence that that's in place.
I'd love to keep going, but we're out of time. Thanks so much.